My name is Todd Beck, and I'm a web seminar producer for ACAMS. Welcome to the ACAMS web seminar, Financial Crime Detection, Understanding Customer Behavior is Just the Beginning, sponsored today by Fiserv. We're pleased to have as a presenter today Jeroen Dekker, who is Senior Product Manager at Fiserv. Jeroen?
Thank you, Todd. So, thanks all for joining me today. Special thanks to people located further east than the Netherlands, where I am located, and where it's the end of the day right now. So thank you for taking that time. By way of introduction, I live in beautiful flower bulb country in Holland, where I am one of about 19,000 people around the world working for a large technology provider to the financial services industry called Fiserv. It does a number of things, including a risk and compliance competency, which does things like reconciliation, financial control, financial risk and performance management, and closer to home, financial crime risk management. And that's where I live. What that means is that we have a software platform that has AML and fraud and other financial crime solutions, primarily around detecting, investigating, and addressing financial crime risks. So our business is to try and help you catch the bad guys, and my part in that is that I'm the product manager for the platform, which means that I'm trying to figure out how to help you get better at those jobs. You may have heard me speak before, because this is the third time that ACAMS is having me, which must mean that I haven't messed up badly so far, so I hope to give you some useful content today as well. The agenda for today: first off, I'll start with a quick history of how we got here, how we got to the point where most of us today are doing customer-level monitoring of behavior in order to detect suspicions of possible financial crimes such as money laundering and fraud. Then I will explain how I believe and we believe we need to go beyond customer-centric detection, after which I'll run through a sizable set of examples from different financial crime domains to illustrate the same point pretty much over and over again, but keeping that interesting, whatever your game might be. After that, I will extend that a little bit into the broader need for flexibility in your transaction monitoring solutions. And as most of these sessions do, I'll end with a wrap-up and Q&A. Before I forget, joining me in the room here is my British colleague Richard McCarthy, who will try and go through any questions that you submit and try and weave them into the session either throughout and or at the end. On that note, let's get started. So, how do we all get started in this business? Well, the stone age of it all is that we did something called transaction monitoring, and that's quite literally how we arrived at the term. And what that looked like in the early days was often printed reports out of mainframe systems that essentially were lists of large transactions, large cash transactions, and then poor compliance officers would have to wade through that list and see if they spot anything that's out of the ordinary or potentially suspicious. So that was rather crude, right? And that got a little bit better over time in that there were like simple aggregations of cash transactions. But then we moved to a new generation because this was very inefficient and also not very effective. We moved to a new generation, a new era of account-level monitoring. And the picture on the left there paints a deceptively simple picture of that concept. And essentially what it means is that you start rolling transactions up to the account on which they happen so that you can start analyzing that in the aggregate. So some things that then become possible and come into play is that you start counting how many times transactions happen on an account, what the total value is of a number of transactions on an account. What gets interesting is that you, at some point, don't just want to aggregate cash transactions and wire transfers and check transactions separately, but you also want to start understanding across those transaction types what the total amount of money is coming into an account or going out of an account. And at some point we wanted to do this not just for a current period, right? How many transactions happened this month, but you then want to start relating that to what's normal for that account, which brought us into concepts like normal behavior, behavioral profiling, some even call it predictive, which is a bit of a marketing term. And smarter and smarter we became, right? Those turn into sort of detection scenarios in which you also started to use account characteristics. What is the account type? What is the age of the account? Is there a credit limit on the account? And what is it? What's the balance of the account? And last but certainly not least, and we'll get back to that later on in the presentation, another wrinkle that is throughout the transaction monitoring world is the concept of counterparties. If someone transfers money from his or her account to someone else's account, that may be another account at the same bank. It may even be an account of the same person, or it may be an account held at some other institution. But an example of the typical kinds of questions that you could start answering in this era is it normal for this account to have sent 12 wire transfers this month, right? It's that sort of thing. Okay, that made us a lot better. And then the next wave came on. People started to realize that people can have multiple accounts at the same institution. They can have multiple payment accounts, they can have savings accounts, loan accounts, investment accounts, what have you. So another layer was added to this whole model, and that of course brought along all sorts of other complexities. You'd have a customer who has multiple accounts. But on the reverse of that, have an account that has multiple customers associated with it. And those customers can have different roles. They can be the owner, they can be a joint owner, they can be a signatory, they can be a beneficiary. So that brought in all sorts of complex questions like, to whom do you attribute this transaction and to whom do you not contribute a transaction? You started dealing with the notion of walk-in customers, some services that you might offer that doesn't require an account relationship by that person with your institution. It brought on the notion, especially well known for most of the AML audience on the phone, of beneficial ownership, right? Is the company that owns this account itself owned by some other company and ultimately by some private person? And people also started dealing with the notion of relationships between customers, right? I have a wife and maybe we should be monitored together for certain purposes. So while only adding one more layer, it added a world of additional complexity that most of us are embroiled in today. And that's, I think, where most of us are today. Now, there are some characteristics of that on a system level, and this is not going to be an IT session by any stretch of the imagination, but there are a couple of important traits. So what the three layers, transactions, accounts, and customers, have in common is that they tend to be distinct and complete data records that the institution's source systems can deliver. Right, be it from a payment system, from a core banking system, or a customer information system, there are records available that live in your source systems. The other thing that they have in common is that you can define formal relationships between them through keys. A transaction record will have an account number in it that allows you to tie it to an account record that came in from another system. In turn, you have something in your system that tells you who the owner of an account is. If not, you may have some problems. On the right-hand side of this slide, I start actually distinguishing between two categories here. On the top there, you have transactions. And what those really are from a system perspective is unique and ultimately transient events that together define behavior over time. And when I say transient, that doesn't mean that as soon as it passes by a system like ours, that it goes away, but it is a one-time occurrence that lives in a system for a while, and then it goes away because it served its purpose. That's different from accounts and customers as you see here, because once you start feeding those into a transaction monitoring system, what happens is that those things start living there indefinitely. And living is sort of the best phrase I can come up with, because it enables the system to start learning and judging the behavior of such entities over time as events come in on them and that affect them, and as investigations start happening on them, that thing grows and changes. Someone's address may change, and the customer record in the system is updated to reflect that change. So these things start living there indefinitely until at some point in the far, far future you could decide to retire it because the account has been closed, for example. But so those traits of these different categories are important to understand the next bit, which I'll go to now. So here's my message for today. Having transactions and accounts and customers is fine, but across the financial crime spectrum, there are many reasons to also start creating and monitoring entities beyond those categories. Right, so the orange entity there is what I mean by expanding your model, and the little explosion there is where I exhausted my PowerPoint skills to indicate that that's a new entity. The other piece of it is that the ability to start monitoring additional entities shouldn't have to rely on your ability to feed a distinct record for it from your source systems. What we think is important is that it's possible for such a new entity to be sprung to life from an event simply by having a unique ID for it in that event. And for the next half hour or so, I will go through a number of examples to illustrate that point. But the point is that it should be possible to almost conjure up a new entity in your system that starts living there, basically from thin air, just by having a unique ID for it from an event. And so if a system can do that on the fly, that's important. So why is this so important? The first example is counterparties, right? Who's sending money into one of your accounts, and where is money going to from one of your accounts? Now, if you take a customer-centric view of that question, it's a rather myopic one. You can say, are these transactions unusual for this customer? Has this particular customer sent money to this account before? Okay, fine, those are useful questions. However, if you are able to have a counterparty-centric approach, right, if you start looking at things from the perspective of an individual counterparty, you can start asking other questions. You can start answering questions like, have other customers sent money to this account before? If so, how many customers are sending money to this account? How much money has been sent to this account? Since when do one or more of our customers have a relationship with this counterparty? So when you think about it in a transaction record, all right, you maybe have the account number of some account somewhere in the world at some other institution. If you're lucky, you have the name on that account. You may know the country and the bank where it is held, and that's about it. That's all you have to go on to judge whether it's being used as a mule account, for example, in fraud, or whether there's a money laundering operation going on that's using that account to funnel money through your institution using a bunch of different accounts. Now, by standing up entities for each counterparty that we come across in an event, you can start answering those kinds of questions. And that's rather important. The next example comes from the specific world of online banking fraud detection. So one of the things that's important in the fight against online banking fraud is the concept of a device, a laptop, a mobile phone, a desktop computer, a tablet device. And a common question that we run across in our business for a detection scenario is, from a customer-centric perspective, has the customer used this device before? And sometimes the answer is no, right? If you're like us geeks here, you buy new iPhones and tablets and laptops all the time. And so if you treat that as high risk by itself, that'll lead to a lot of false positives that you need to deal with, or your system needs to deal with, one way or the other. If, however, you start immediately when you, for the first time, you see a device ID come by in an event, if you immediately create a record for it, an entity for it that starts living, you can start detecting the next time an event comes in that uses the same device. So a question that you can start asking, has this same device been used to access the accounts of a number of other customers? Because that shouldn't be the case, right? My laptop should not be used to access the accounts of 5 different customers. That's not how online banking tends to work. So if we have seen it before, similar questions: how many, since when, for what? Because if that's the case, we can detect that this is apparently a device that a fraudster is using to attack your customers and their accounts, and that gives you a chance to then block it, put it on a list that prevents access.
Jeroen, Richard here, the panelist. Could I just stop you a moment? We're starting to get a few questions. The first one is, could you just clarify for the audience? They're asking, here you talk about an entity and you talk about customer. Mm-hmm. Could you elaborate a little bit what the difference between the two is, please? Sure.
A customer is an entity, or at least in the way I talk about this. A customer is an entity. The things that make it, well, first of all, so far the industry has largely decided that accounts and customers are the most, if not only, relevant entities that exist for a lot of financial crime detection. And part of the message here is that there are a lot of other entities that are equally important and relevant for effective detection. The other difference in these kinds of examples is that a customer is an entity for which an institution can typically deliver a full record from its source systems. The examples that I'm going through here right now don't require that. They can be pretty much conjured up, as I said, from thin air, from an event that only has a unique ID for a particular entity in it.
Yeah, thanks, Jeroen. Just a reminder, if you do want to ask a question, do use the Q&A at the bottom. For those of you who are shy, if you really want to test it, you can just put your city name in, but we're still getting some questions, so we'll go through them as Jeroen speaks. Thanks, Jeroen.
All right, sure. So with that, the ability to start monitoring devices becomes a powerful additional angle of attack against the fraudsters. So the next example uses, again, a totally different entity. Here we zoom in on an ATM, right? A machine where you can withdraw cash. So take a skimming attack. What tends to happen is that fraudsters plant a skimming device at a retail store somewhere, a gas station lately, and skim the details of a number of cards. Now, what they typically do is they go to some other country to start, after they clone the cards, to start withdrawing a bunch of cash in rapid succession, right? Because they're going to be found out at some point. So they go to some ATMs and use all of those cards to withdraw as much money as they can. So let's say they do this in a country in Eastern Europe. Now, if I'm one of the victims and the bank sees me withdrawing cash in Eastern Europe, that may or may not be unusual for me. But hey, people go on vacation, even also to Eastern Europe, and is that enough information to block the withdrawal or block the card? Maybe not, probably not even. Now, what if you start looking at it from the perspective of one of those ATMs? What you would see is that all of a sudden, over in some random ATM over in a country in Eastern Europe, all of a sudden they see 10 Dutch customers starting to use their cards at the same ATM to withdraw large amounts of cash. So if you analyze the behavior from the perspective of the ATM, that's where you can start seeing the attack in motion, right? The skimming has already happened elsewhere. That's not what we're talking about here. We're talking about the subsequent act of taking the cloned cards and withdrawing a bunch of cash. So the idea here is that looking at it from an ATM perspective allows you to identify things you wouldn't see if you just look at the customer behavior itself. On to the next one, corporate account takeover. So let's say you have a business customer and that has access to online banking, and one of the things they can do there is initiate wire transfers. And what they do is they have 3 users who are authorized to set up and initiate wire transfers. Okay, that's fine. And so wire transfers happen, and looking at it from the company's perspective, the frequency and volume of wire transfers may be close enough to normal for it not to set off any alarm bells. Executing a check to see whether the wire transfers were made by authorized users also doesn't set off any alarm bells because all of them were. Now, what we've seen is that those 3 users tend to be different in the wire transfers that they initiate. What tends to happen is that one or two of those users are the ones who always initiate all the wire transfers, and there's one of them who rarely, if ever, does it because that person serves as the backup for if the others aren't available, for example. And what we've seen is that that's the user whose account gets compromised. And so that's the user who starts initiating wire transfers, but it's really not the user, it's the fraudster who's taken over his account. The only way to capture that is to understand the normal wire transfer initiation behavior of each of those users so that you can spot the fact that it's the anomaly, right, the rare user who's initiating these wire transfers. And again, that's another example of not just monitoring the company, but setting up an additional entity that's relevant to the behavior and understanding behavior over time for each of those entities. On to the next one, ACH Originator Monitoring, another walk of financial crime and compliance, arguably. And we're talking about Reg E claims here, right? So customers complaining that there was an unauthorized transaction on their card, for example, and they want their money back, right, for which they call the institution. So in this example, the institution's customer is a retail chain and who has an account, and that's what you're monitoring. Now, that retail chain has a number of locations who are merchants in the ACH spectrum. Monitoring the number of Reg E claims only on the level of the company, of the retail chain altogether, is useful, but may not allow you to zoom in on anomalies within that chain. The ability to start monitoring each location as a separate merchant in your business model allows you to say, are we seeing an extraordinary number of Reg E claims at a particular location? In which case, that's something you want to zoom in on to see if there's something wrong going on there with the way they do business, with their employees, them being abused or willingly collaborating in a crime scheme, or operational problems, whatever the case may be. So that's an example from the ACH world.
Yeah, Jeroen, we got another few questions coming up, so I just want to interrupt you a moment. A lot of questions, but I think they can be grouped into related to data. So obviously for these detections, data is important. So the type of questions we're getting is like, who is responsible for the system records for following the transaction? And they seem to be asking questions like, do you see that being the responsibility of the FIU, or is it the responsibility of the bank?
Good questions. Now, certainly there are use cases for this concept and this model on an FIU level, on a regulator level, who have the so far unique ability to look across institutions to spot such things, right? If they have, and maybe they do, right? Maybe they do dive into their databases to query on social security numbers to see patterns cutting across different things. Mostly I'm now talking about implementing transaction monitoring at individual financial institutions where the responsibility for feeding the system with data is on the institutions. Now, there are plenty of system integrators or vendors that will offer to help you with it, but the data typically doesn't need to come from the institution as far as their business data is concerned, which then can be augmented with other data providers that provide individual databases for certain things.
Yeah, Jeroen, another question. This is just to clarify. You mentioned Reg E claims. Mm-hmm. Can you just spell that out? What that is, please?
Regulation E, but it's a U.S. regulation that defines liabilities, responsibilities, rights, and those sorts of things around the relationship between financial institutions and customers and retailers for unauthorized transactions, for transactions that the customer claims as being something that they didn't authorize. So there's a whole it's a whole regulation with documents and processes around it. Yep. Okay, moving on. Money laundering and sanctions violations. Rather topical given the recent enforcement actions that we've seen targeted at large financial institutions in recent times. And apparently screening transactions for names and countries of sanctions countries and entities was not enough to prevent it. However, could you have prevented it if you had a better understanding of large or new money flows going through your institution? So it's correspondent banking, right? So you have transactions, for example, SWIFT payments, that can involve a number of banks. And the role of the bank may be different. It may be an originating bank one time, it can be an intermediary bank another time, it can be a receiving bank a third time. Now, if you're lucky, in each of those instances, that bank will have the same unique ID associated with it. It can be a BIC code or an ABA number or what have you. If you have that, you can, the first time you see a particular BIC code, I'll take that as an example, you can extract that into a new entity called a bank or an institution, and from that point on, you can start looking at all of your SWIFT payments in this example to start understanding that, whether particular banks or branches of banks are responsible for disproportionate amounts of money flowing to or from your institution or through your institution en route to somewhere else. And that may allow you to pick up on sanctions violations or large money laundering flows going on. And I have a particular example of that later on in the presentation. Another example from the world of money laundering is I would almost say good old cash structuring, but it equally can apply to abuse of other non-customer products. What I mean by that is services that you may remittance, prepaid cards, that sort of thing, that don't necessarily require a full customer account relationship. So cash structuring, right? You tend to look at that from an account perspective, and above that from a customer perspective across their accounts. You may even look at it based on a TIN number if you're in the U.S. And that allows you to do that aggregation, whether in the U.S. where cash exceeds $10,000 a day or is an attempt to evade that reporting requirement. Now, what that doesn't capture is the guy walking into a branch with a bag of money, or the lady standing at an ATM to make such deposits. If you can capture, and that's been an industry balance for decades almost, but if you can capture the things the ID that makes that transactor unique, you can start seeing if that person is walking into a number of branches throughout the day to deposit money into a number of accounts. In which case, it still is a case of more than $10,000 in cash executed by the same person on the same day. Another question.
Yeah, Jeroen, if you don't mind, I'm going to just try and roll back to the ATM example, because there's quite a few questions come up on that one.
Okay.
Perhaps too many to go through right now, so we'll address those later if need be. But just to give you an idea, one question came in, and that's quite generic, not just to ATMs, but the question is, how do you determine all the different devices that you're talking about here?
So I'll interpret that as the different kinds of devices, and that's part of the exercise that the institution would go through if you would work with us as a vendor with us to understand your business world, your financial crime problems, your channel structure, and what kind of ATMs there are in that example, right? So let's say we decide to use ATMs as a particular entity for this kind of scenario, then we go and see whether your transaction records include an ATM ID that can be considered unique. If so, all right, let's model that and stand up that as an entity. And what a system ought to be able to do is create an entity for a given ATM from scratch the first time it sees that ID come by.
Yeah, and like I said, there's quite a lot of questions on this one, but I think to try and wrap them up in a time, I'll try and phrase it this way. Again, on the ATM example, some people are asking questions like, this would depend, that you could detect this. So, for example, for that type of ATM example to be detected, would we not have to collect some history here of transactions at ATM machine?
Yes, and that's exactly what you can start doing. And granted, right, if that ATM is seen for the first time by your institution, it's never seen that Eastern European ATM before. Granted, you don't have a lot of history, but still your detection rules could say that it would be odd for that, in principle, it would be odd for that ATM to first immediately be used by a number of foreigners compared to the ATM location in the first instance, right? So in that case, you don't need a lot of history to judge it as unusual and suspicious. All right, thanks for all those questions. Appreciate the interest. But in the interest of time, I'll move on. So I think I've covered that cash structuring example, which allows me to move to the world of insurance, and I have two different examples here. The first one is medical insurance claims fraud. Lots of that going on, obviously, which also has the governments around the world very concerned. But it also applies to insurance firms who have group benefits products, for example. Now, if you look at a given beneficiary of such a policy, you may ask whether the treatments that person is receiving are normal or warranted, or whether the prescriptions they're receiving is normal. Well, how do you really know, right, without spending a lot of time and energy visiting that person and diving into it? However, those treatments and prescriptions are provided by, well, the word says it, by provider, right, a physical therapist, a doctor. And if you can turn those folks into entities, you can start understanding their behavior. You can start monitoring what they do. For example, you can start seeing, and this is an actual implementation that we've done where we saw this, that a physical therapist was claiming 15, 20 hours a day of treatment, even with the same insurance company. So he wasn't the smartest fraudster in the world. But nevertheless, it's pretty uncommon for a physical therapist, I believe, to be working 15, 20 hours per day. So the fact that he was claiming that many treatments was just impossible. So by looking at his behavior across the different beneficiaries of your group benefits policies, you were able to spot the fraud. Similarly, if a doctor is prescribing an enormous amount of pills compared to the number of clients that he has or his peers, that can also be a sign that he's abusing the system to get payment for things that he didn't prescribe or needlessly prescribed. So in those examples, looking at providers as entities allows you to catch more fraud. The next example is another party to the insurance business, and those are insurance agents or intermediaries or brokers or providers, whatever you want to call them. And those are an important subject of monitoring for insurance companies looking at financial crime, whether it's money laundering, whether it's fraud, whether it's market conduct like predatory selling. Now, for each individual policy and policyholder, you have some information, and you have to weigh whether something being high risk or unusual is strange and suspicious enough to warrant an action. However, if you start aggregating that by the agent that's involved with all of those policies, you may uncover some strange patterns. Is this agent unusually successful in selling certain policies? Is he focusing too much on a certain kind of policy? Are we seeing high-risk things happen on those policies? Are we seeing a lot of cancellations, early withdrawals, churn, death claims, right? There have been some terrible examples of that. So by monitoring on an agent level, you can start spotting those patterns. And the last example in this row of examples is focusing on internal fraud, looking at branches or individual tellers at those branches. So if you take a customer-centric view, okay, you can see if that customer has a tendency to do business at a particular branch or even with a particular teller at that branch. Okay, well, that may just be force of habit. It may be his cousin or his neighbor that he likes to do business with, which can be very innocent. If you start monitoring branches and tellers in their own right, you can start asking questions like, are we seeing a pattern of customers that either have high-risk characteristics or that are displaying high-risk behavior seeking out a particular branch in your network or a particular teller at your branch? And that's then a clue that can spot to internal fraud, or at least incompetence in combating financial crime. Richard, some more questions, I see.
Yeah, so Jeroen, I think we seem to have a very intelligent and diverse audience here because they're all giving different examples of where these sort of detections could have its challenges. I think we'd be the first to admit there are challenges here. But just to give you an example, I mean, we got some people from, I guess, banks from Chile saying, you know, they're using cards with chips. That introduces some new challenges. We get some people from Florida talking about if a person is using an internet cafe for online banking, well, the device and the place always changes. So clearly, you know, this introduces more complexity how to detect that.
Yep.
Is there any comment you want to make on that? Do we acknowledge the fact that this is complex, or are there some ways around this for them?
So with all measures and tools against financial crime in general, there doesn't appear to be a silver bullet that you just turn on and it solves all problems for all eternity. And if I were to claim that here, I wouldn't have a lot of credibility, I'm sure. On the card with chip example, that's actually an interesting example because what we're seeing is that that takes the fraudsters elsewhere, into countries where that don't use the chip yet, and where they don't have to have that in order to clone the card and make false withdrawals. So that actually plays into the example by the pattern that they'll move abroad first after cloning the cards in order to do the withdrawals. To the internet cafe example, I don't know about the wisdom of consumers using an internet cafe to do their online banking, but it's a fair point that that's something you would need to look at in detail in order to set up rules around it to avoid the false positives caused by that sort of thing. Right, so yeah, to every example there will be exceptions, and that's why you need to have sort of a granular system that can be tweaked and honed to rule out those kinds of things.
And just one last point before I let you roll on there, Jeroen. Some of the questions are relating to how we tie all the investigation pieces together, and they're asking questions like, does link analysis still have a place? I think, as you'll probably elaborate, this is new, but you're still using the same investigation techniques as before, case management, etc.
Yes, you will, and that's part of the power, and I'll get to that later, is that once you have an entity in your system and it starts living there, you start learning behavior, alerts start happening on it, and therefore an investigative history starts being built on it, right? That's actually quite useful, instead of it just being some random a data mining match of, hey, we've seen this number before somewhere. So yes, later on in the presentation, time is flying by the way, I'll actually elaborate on the difference with link analysis. All right, so moving on at some pace. So switching gears a little bit. So these are all examples of a new entity being sprung to life for an individual instance of a person or a place or a thing. Another application of the concept is that you can start monitoring larger populations to spot patterns and risk. So that an entity represents something like a country or a particular banking channel or a particular customer group. So for example, a group have an entity that represents your elderly customers, and so can you see an attack pattern on that focuses in on elderly customers. The example here on the slide is interesting and something I alluded to earlier. So you have obviously sanctions programs. Let's take Iran as an example. And what you saw at some point is that transactions, so banks started seeing sharply growing transaction volumes from a country called Tajikistan, which is right next door to Iran. So lo and behold, they tried to use institutions in that and businesses in that country to evade sanctions. Now, if you have entities that represent the countries in the world, and you roll up events and customers to those entities, you can start spotting if all of a sudden Tajikistan transaction volume starts growing a lot through your institution. So there are a number of examples here where you can use the same concept on a more abstract and aggregate level to spot larger trends and patterns. Now, there's obviously a balance there that at some point you start moving out of detection territory and into management reporting kind of territory and analytics territory. But the concept is the same and worth considering if you're thinking about transaction monitoring. So, to some of the earlier questions, isn't this whole concept just, and I say just in quotation marks because big data with data mining and link analysis, fuzzy link analysis is nothing to sneeze at, but it's not the same. What I've been talking about here is a structured and predefined way to do your business modeling. You make a conscious decision that ATMs or banks are something you want to start understanding. and you can start telling the system what kind of behavioral metrics you want to start keeping on those entities, right? Is it volume? Is it frequency? Is it questions like, is this the first time? Since when have we seen this behavior or this entity? So very targeted questions instead of just fuzzy output like, yeah, we're seeing a match here somewhere in our big set of data. Now, what that then allows you to do is for those entities to be created in real time and also to be judged in real time based on thresholds. Is 4 a normal number of customers whose accounts can be accessed from a single device? Is it 2? Is it 6? That's stuff you can start setting up, which is different than what big data type of solutions do. And finally, as I just said, those entities can start living in a system where investigations start happening on them, which is stuff you can use and leverage later on if you run into that same entity again, right? So it's a much more structured and conscious way of leveraging the data that your source systems are able to feed you. Now, link analysis is still an important part because we are talking about a lot of links, some of them very formal and obvious, some of them you uncover as events come in. So next to the detection side of it, the ability to use the same business model in your investigation environment, if you have that, is equally powerful. So expanding that very singular, but for many users, but it's a very singular concept, a bit to the broader need to be flexible in what kind of data a transaction monitoring system receives and what kind of business model you derive from it. Chances are, over time, you'll want to start feeding the system with new types of events or new entities. You've just launched you're about to launch your new mobile P2P remittance solution offering that you have a joint venture with some telco with or something. So that new channel that generates new types of events, right? A person logs in with mobile device and sets up transfer to his peer through NFC communication field or something. Chances are you also then want to start feeding mobile devices or creating mobile devices from events as they happen. Do you want to buy a new system? No, because it's just another channel that feeds into the same overall holistic account and customer monitoring that's still important to your overall view of risk. Chances are that over time additional properties become available. Maybe in your customer information system, hair color becomes available, and that turns out to be a great predictor of financial crime. Flexibility is then important for you to be able to add that property to your overall implementation. And finally, you can do a lot of thinking around how you model your business. And I'll give an example of online banking, where we run into clients who have an online banking environment where a consumer has an online banking account, and that's an entity. And once you log into that online banking account, that gives you access to your payment accounts, your saving accounts, your joint account, as an example. But the overall relationship is governed not by those accounts, but by a contract with the customer that is a package deal that supersedes those three accounts. And banks want to model, or other types of financial institutions, right? Insurance, investment, doesn't really matter. Banks all have their little differences and tweaks in how their world works, and how that evolves over time, and what kind of risks you want to be able to identify. So the message being that your business is unique, and your needs will change as your environment evolves, right? And there are some dimensions there: business, technology, crime, and regulation. And so to that end, what you want is a sort of overall flexibility to feed new data and create new entities. Richard.
Yeah, Jeroen, so questions still flying in, lots of them, so our apologies if we can't cover more. We'll certainly try to address them one-on-one later, but just to give you an idea of the range of questions, we've gone through some examples, people asking about can we think of how we could detect things for mobile, for checks, trust service provider sector. So all these I'm sure we can't cover right now, but perhaps I could just pick on one. I mean, there's even one on medical insurance. So I'm going to just suggest the mobile banking one. You see good examples of where this could be applied there?
Sure. So depending on the offering, the mobile device that's being used can be an entity you want to start monitoring, right? Is it being used to, with global remittance, is it receiving money from a bunch of different accounts from a source country, or vice versa? Is one mobile device being used to fund a bunch of other phones? You can separate the phone itself from the mobile wallet account that it lives on, right? In case people switch phones while keeping their mobile wallet account with the institution. So that's an example of additional entities you want to model. Even in the check world, thinking of deposits, for example, right? A guy walks in with 10 checks. That's called a deposit, which can hold 10 checks, right? 10 items. So there, you can, and we've had this. We've run into the situation in the past. You can debate whether the deposit should be treated as a transaction or whether each individual check should be treated as a transaction. Arguably the latter, but then it would be good to also understand what deposit they were part of. So then you model the deposit to have that information as part of your chain. All right. That actually takes me to the wrap-up. Time has flown by, I must say. So don't let this be a message that account and customer monitoring can be done away with or are not important, right? They are still the cornerstone of most monitoring to combat financial crimes, ranging from fraud to catching corrupt politicians to sanctions. So they are important and great, right? And it's a lot of what we do today. However, as I hopefully showed you in the past hour, we also see a lot of value in also monitoring other types of people and places and things and even groups of things or people of places. And why would you do all of this, right? Well, for one thing, if you judge an event from many angles, or if you judge behavior from many angles, it makes it that much harder for criminals to cover every angle. The good ones by now have caught on to the fact that we're trying to understand what's normal for a customer, and so they try to not get too crazy with their transactions to stay within normal bandwidths, right? Okay, that's fine, but can they also do that if we look at the device they're using, at the accounts they're sending money to, at the ATMs they're standing at? Right? If you make them run a virtual gauntlet of tripwires, can they evade them all? Right? So with that, applying this concept for, well, whatever domain I went through today, and there are more where that came from, allows you to detect more and also lower false positive. Right? To the new device example, you don't want to continually raise alerts or even block transactions just by people getting new laptops, new iPhones, and what have you. So if you look at it from the perspective of the device, that gives you something else to go on. As I covered in responding to one of the questions, this concept should not just apply to detection scenarios. It's equally important for subsequent investigation of entities and doing trend analysis on a sort of larger periodical level. And the final point, as I hopefully explained, we as a vendor deal with a lot of different financial crimes at different types of institutions in different countries. So, and for each of you, the story is the same for you, right? You have different needs and evolving needs. So whatever your capabilities are for this sort of thing, you want them to be flexible to implement and adapt in the future. So I think that's all I have. So on this Q&A slide, I'll give Richard one more chance to ask any remaining questions before I turn it back over to ACAMS.
Jeroen, thank you very much. So indeed, we've got a large stream of questions, and we will get to them if we don't answer them now individually by email if we can.
Sure.
But just to give you some of the ideas, I mean, we've covered a lot today, from online ATM insurance. One interesting question I'd like to pick up on is someone's asked a question of, since AML indicators rely quite a lot on historical data, what can we do to detect a major active event? And the examples they give in the question is like a massive cyber attack or a terrorist attack. This is, I guess, the beginnings of trying to detect things quickly rather than historical data. Have you got any views on that?
Sure. Well, detecting a major terrorist attack is something that we as an industry haven't been great at in terms of terrorist financing. So I'll leave that one be, if I may. But to a large cyber attack, right, which I think is defined as the cyber criminals not just attacking one customer, but attacking either the institution as a whole or specific set of customers or accounts. And that's one of the points I made, right? You can apply this concept by creating entities that represent certain aggregated groups. All my accounts, all my old customers, my private banking customers, my ATM channel, my online banking system, so that you can start monitoring them in the aggregate and spot patterns in real time as they start to emerge on such an aggregate, right? So instead of and the other way, even if you don't, right, if you start seeing a bunch of alerts pop up in real time and that have something in common, that's another way to spot a large attack early on, right? And obviously, there's other ways to try and prevent that sort of thing, right, with sort of locks on the door kinds of authentication and security measures.
Yeah, thank you, Jeroen. And again, we've got quite a large, we're coming up to literally the last 2 minutes, so I'll make this my last question. As I say, we do have quite a lot in the medical insurance sector, and we have some coming from internal fraud. So I'm just going to ask that last question, really,
okay,
which is just a reminder, we didn't talk too much about internal fraud, but could you give something to indicate, can banks with this type of technology detect internal fraud?
So the answer is yes. So typically what you so think of call centers, for example, or branches, where think of call centers, right? If you start seeing that a call center employee is accessing someone's account without having calls from that customer to justify that sort of behavior, you can start spotting early on if he's looking into stuff that he shouldn't be looking into, right? And if he's then involved with changes to an account or even initiating, so for example, he breaks into a system and sets up a new signatory on the account who's able to initiate transfers, right? Having the call center employee as an entity allows you to monitor that sort of behavior. So it's 5:59 on my clock here in the Netherlands. So I think that makes it time to throw it over back to Todd at ACAMS, and I would like to thank you all for the audience for listening in and asking so many questions. I hope it was useful, and for ACAMS for having us. Good day.
Jeroen, thank you, and thank you, Richard, for wading through all of those questions. Sometimes we have very few. Today we had, I swear, 100 questions come through, and that was wonderful. Just to ask the obvious, one of the questions that came through was, it seems like an overwhelming amount of things to think about. How do you propose implementing this kind of tracking? I'm guessing Fiserv has ways you can help with that kind of thing. Is that correct?
Yes. Well, first of all, you need the software that has this sort of capability, and then you need people who have some experience and expertise in what is relevant and what's possible, right? So what it then becomes is an exercise of sitting down with an individual institution from our side with what we've seen work before and what's useful for a given financial crime problem in a given industry. And from the institution side, their own perspective on that, and then also their availability of data from their source systems. That's where the two come together to decide what's useful.
But you are available to help.
We certainly are, yeah. But I'm trying to not offer our services too blatantly.
I understood, and I appreciate that. Thank you for everyone for asking all the questions. If you have additional questions for today's experts, or if you have suggestions for future web seminars, please send those to training@acams.org.